All right, good evening, everybody, and welcome to another question of the day of the Griepentrog Stock Market News. My name is Elias Griepentrog, and I'm the founder of the Griepentrog Stock Market News. The Griepentrog Stock Market News is basically a podcast in which I summarize and explain every trading day so that you can spot the bull in every scenario. Now, this is basically a new concept here to this YouTube channel. What I do is on every weekday, I pick a question of the day that is highly relevant and I explain it to you. Now, today's question of the day is a little bit of complicated topic, but I will explain it very quickly. I will answer the question very quickly because these videos are supposed to be kept short. Now, today's question of the day is, will the Federal Reserve cut rates this year? So there are three main reasons why I believe that the Fed will not cut rates this year. Now, the first reason already up here on the board, the labor market. Now, the labor market remains incredibly resilient. What we are seeing is we are seeing some data that is indicating a slowdown of the labor market. For example, the ADP payrolls number that we got around 3 or 2 weeks ago showed that the labor market is showing some signs of cooling down. Initial jobless claims are sometimes surprising to the upside. And yesterday we got a number on unemployment aid, which also increased more than anticipated. So the labor market seems to be cooling down. But then in the most recent labor market report, we saw that the unemployment rate actually fell to 3.5%. And this indicates a very resilient labor market. Now, what we are seeing right now is, I believe, and Mohamed El-Erian said this too on Bloomberg The Open, I believe that we live in a world of deficient aggregate supply. We're seeing political instability. We're seeing, obviously, the war in Ukraine. All of these had a significant effect on supply chain. So there is deficient aggregate supply. Now, because of this deficient aggregate supply, companies have been able to raise prices significantly in 2022, 2021. So basically, this rise in production costs, this disruption to supply chains, gives companies certain pricing power if these supply issues affect all companies. And what happened was that obviously in the pandemic, a lot of liquidity was pumped into the market, consumers built up a lot of savings. So these companies were actually able to pass on these higher prices to consumers. And what we're seeing now is debit card and credit card spending is still growing faster than inflation. So the consumer is very resilient. Companies can continue to pass on higher prices to consumers, which means that inflation will not be on a sustainable downward trajectory. So in order for the consumer, it does sound harsh, but I believe that needs to happen in order for inflation to fall back to the 2% target. In order for that to happen, for price stability to be restored, the consumer needs to lose some of its resilience. And that only happens when we start to see slack in the labor market. Larry Summers had summarized this very nicely a couple of weeks ago on Bloomberg Wall Street Week. He said to David Weston back then that you cannot get inflation down if you don't get wage inflation down. And in order to get wage inflation significantly down, you need to see slack in the labor market, meaning that the unemployment rate has to rise. Another example, BlackRock. BlackRock believes that we should not read too much into the headline inflation number or into the inflation number in general. We are seeing headline inflation come down at the moment, but mostly because of falling food and energy prices. Core inflation remains very, very sticky. Christopher Waller, the governor of the Federal Reserve, he said that we're not making much progress on core inflation. And that basically means it's an indication of why the Fed will stay hawkish. We're not making such progress with core inflation. So BlackRock believes instead of reading too much into the inflation figure, we should be looking at the labor market, because that is simply a better representation of whether or not inflation is on a sustainable downward trajectory. Like the Cleveland Fed president said recently, before the Fed cuts rates, it needs to be sure that inflation is on a sustainable downward path. And that is only the case when the labor market is losing some resilience. So I believe the Fed will not cut rates this year because the labor market still remains incredibly resilient. And I don't believe that the unemployment rate, given that I expect the Fed to raise rates by another 25 basis points in the May meeting. Markets are pricing in that rate hike, but markets are also pricing in rate cuts by the end of this year. I believe that the Fed cannot cut rates given that it's such a resilient labor market. And I don't believe the labor market will lose resilience in 2023 to such an extent that inflation can fall back to 2%, which is obviously also not that will definitely not happen this year. And so yeah, I believe definitely the Fed has to stay hawkish throughout this year. Now, the labor market is one reason why the Fed will not cut rates this year. If you look at financial stability, and if you look at financial stability, the recent events in the banking sector, for example, the collapse of Silicon Valley Bank, we saw a significant fall in treasury yields because investors were rushing to save bonds to treasuries. To, for example, the 2-year treasury yield significantly decreased, the 10-year decreased, because investors believe that we are seeing a banking crisis now. However, we are now in the midst of earnings season, and the numbers I saw from the big banks, they are indicating that the banking sector is still in a very resilient position. So. And Mohamed El-Erian summarized this nicely on Bloomberg Surveillance. I think it was a couple of days ago. He said that we should not call this a banking crisis. This is simply a banking tremor. So we will not see, and we are not seeing sufficient narrowing of credit availability in order for the Fed to cut rates. Obviously, if we were to have a banking crisis, if we were to have a credit crunch, that would obviously do a lot of work for the Fed. That will have a lot of disinflationary pressure. So it will help get inflation back to the 2% target, and it might allow the Fed to cut rates sooner. But as of now, the banking sector is still very resilient. Now that is the second reason. And I did kind of lose my train of thought here because there was a third reason, a third very important reason. And yeah, I mean, I kind of already touched upon this earlier. If you look at just inflation in general, some people might say, hey, we are going to see the Fed cut rates this year because inflation is coming down. And given the, just in general, the state of the economy, obviously the state of the economy is a very important factor. If we see too much weakness in the economy, the Fed will cut rate in order to ensure that we don't see much more damage. And I believe in order to ensure that inflation does fall back to the 2% target, the economy has to lose some of its resilience. So this is kind of going into both ways. If the economy loses resilience, inflation will fall and the Fed will be able to cut rates. Now, given those last two factors, inflation, people are saying, hey, we are seeing inflation come down. We're not really seeing inflation come down. The headline inflation is coming down, but core inflation, which is really the more important indicator of underlying inflation, still remains very resilient. Economy, people are saying to me, Elias, come on, we are seeing retail sales, for example, fall. They tell me we are seeing ISM PMI manufacturing data lose some of its resilience. What I tell them is, sure, we are moving in the right direction. But the fact that we are seeing a slight cooling down does not justify rate cuts, I believe. It does not justify it. And especially you need to consider, sometimes you need to look at the data more closely. Think about retail sales, for example. At first sight, the overall retail sales number, it is falling more than expected. But what you do then, same story with inflation. It's absolutely, I love it. And it's fascinating. If you strip out energy, if you take energy out of retail sales, then you realize that retail sales actually surprise to the upside. It is the same with inflation. You strip out energy, you look at core, it remains resilient. So you really kind of, you need to look at the data more closely in order to get a better idea of where the economy truly is. And energy prices are extremely volatile. With the China reopening, China recovering right now, truly on the way to economic growth and economic strength. China, the fact that this economy is recovering might push energy prices higher, which means that the overall retail sales number might surprise to the upside. And then I will tell you, hey, I did tell you all along that the underlying core inflation and the retail sales are not really surprising to the downside. We just really need to look at the data more closely. So about the recent events in the banking sector, about financial stability, BlackRock, Blackstone, JP Morgan, all of these big US banks and asset managements, they believe that the market is putting too much, the fact that they're pricing in rate cuts this year is premature. All of these big banks are telling us the Fed will not cut rates this year. They're saying that, especially JP Morgan and BlackRock, they're saying that the recent events in the banking sector do not justify the Fed cutting rates, which makes perfect sense because if you look at the earnings reports right now, the banks are in pretty good shape. So just to sum this up, and to be fair, I kind of I did this presentation before, and I wanted to make a shorter video. It ended up being 30 minutes, so I'm kind of going a bit quicker now because I tend to talk too much. So just to kind of sum this up. Will the Fed cut rates this year? I don't believe that the Fed will cut rates this year, given the fact that the data is so resilient. In order for inflation to fall back to 2%, you need to see weakness in the economy, you need to see some deterioration of financial stability, you need to see the unemployment rate rise. We are seeing the labor market slightly cool down. Obviously, financial stability, the recent events in the banking sector, mostly, I believe these happen because banks fail to adapt and because of management issues. If you have rising treasury yields to such an extent, people will pull out their deposits and invest them into treasuries, which now offer a much higher yield than leaving your money in savings. And these rising yields will these rising yields on treasuries, in addition to the outflow of deposits, will cause banks or will force banks to sell some of its treasuries at a loss. So I believe, these events in the recent events in the banking sector mostly because of management issues and the failure of banks to adapt. So some more deterioration of financial stability, some more weakening of the economy, especially a loosening of the labor market is required in order for inflation to fall back to the 2% target. And before we really see these things deteriorate, the Fed will not be able to cut rates. We have a very data-dependent Fed. Of course, we need to take into account the fact that monetary policy affects the economy with a significant lag. But just remember, just like BlackRock said, if you want to know whether or not inflation is on a sustainable downward trajectory, look at the labor market, because that will give you a lot of information. It will tell you whether or not inflation will actually fall back to the 2% target. Oh, okay, well, that is it for today's question of the day. I really, really hope that you enjoyed it. I hope everything that you said makes sense. Sometimes I am, of course, losing track a little bit because there's just so much you can talk about. And if you kind of speak freely and you don't practice and you don't take notes, I mean, this is what all of this whole concept is about. Kind of going with the flow and letting my thoughts, like giving a free flow to my thoughts, so I kind of can organize them in my head and get a better idea of what is happening myself. But sometimes I do get lost, and obviously I need to take some time to gather my thoughts again and stay on track. But yeah, if you would like me to discuss any certain questions of the day, just write them in the comments. This is my hobby. I truly love doing this. And yeah, it would be great if I could answer some of your questions. Now, I am an economics student, so this hobby definitely helps me with my studies, and I would be happy to answer any questions and invest some time, as long as, of course, they are about economics. Now, today's Friday. Another question of the day will be released on Monday. I hope all of you have a great weekend. And yeah, enjoy the weekend and bye-bye.